When an agricultural business is turning a healthy profit and dominating its home market, executives face a difficult mathematical question. Why authorize an expansion across borders, where the firm immediately takes on the systemic liabilities of volatile exchange rates, facing unfamiliar regulations, and complex international logistics? The answer lies in the constraints of a mature domestic economy. In a fully developed market, total demand eventually flatlines. Growth becomes a zero-sum equation, forcing companies to expend immense capital fighting entrenched competitors just to secure marginal fractions of market share. To understand the alternative, we can look at the formal market growth equation. This split-screen chart illustrates the difference. On the left, a mature domestic market relies on a slow baseline growth rate, represented by the constant alpha. On the right, the demand curve for an emerging international market behaves entirely differently. In developing economies, that baseline alpha constant is eclipsed by compounding multiplier terms. The beta 1 term represents rising personal incomes, and beta 2 captures rapid urbanization. As millions of people move into cities and increase their purchasing power, these beta factors multiply against the baseline, driving the demand curve sharply upward. Expanding internationally requires a calculated pivot. A firm must abandon the strategy of competing for stagnant share and reposition its supply chains to capture this faster-growing, multiplier-driven global demand. We can observe the specific financial risks of this pivot by looking at a standard cross-border transaction. Consider a successful U.S. corn exporter that secures a massive 50,000-ton contract with a network of buyers in Mexico. On paper, this creates an immediate diversification benefit. By exporting a large volume of its product, the firm mathematically decouples a portion of its revenue from U.S. domestic demand shocks. If local prices fall, the international contract stabilizes the balance sheet. However, trading away domestic demand risk introduces an entirely new systemic threat: foreign exchange volatility. This financial ledger breaks down the Mexico contract. The exporter sells 50,000 tons at a fixed price of 4,400 Mexican pesos per ton. At 20 pesos to the dollar, that generates $11 million. But if a stronger U.S. dollar pushes the exchange rate to 25 pesos, the 220 million pesos converts to only $8.8 million. $2 million in profit is instantly erased. The exporter executed the contract flawlessly. They shipped the exact 50,000 tons of corn, on time, and collected the exact 4,400 pesos per ton agreed upon. Operational perfection cannot protect a firm from macroeconomic shifts. Without financial tools to hedge against currency fluctuations, exporting simply replaces the risk of losing a domestic customer with the risk of losing the value of the currency itself. Currency is only the most visible variable. Moving an agricultural product across a sovereign border introduces compounding layers of hidden friction that do not exist within a domestic supply chain. The landed cost equation calculates export viability: base production costs, plus tariffs, plus sanitary compliance, plus policy uncertainty. Base cost C is just the start. At the border, T tariffs compress margins. Then, hidden S regulations and U policy delays consume whatever profit margin remains. International profitability requires sophisticated coordination. A firm must optimize its logistics to minimize sovereign trade policy friction, or landed costs will exceed value. Even if a firm successfully navigates the entire global supply chain and achieves a highly competitive landed cost, they face the most rigid barrier in global trade. A low price does not guarantee market acceptance. Culture acts as the rigid operating system of a society, dictating the precise rules for transaction costs, consumer trust, and purchasing behavior. This complexity is heightened by the mechanics of communication. With up to 70% of business interaction relying on nonverbal cues, a message can be lost or misinterpreted long before a contract is signed. Consumer demand follows a cultural acceptance equation. Products must fit local tastes, social norms, and cultural beliefs. Since these variables multiply, violating a single norm drops that variable to zero. Consequently, total market acceptance instantly falls to zero, completely neutralizing any price advantage. At retail, the exported product must seamlessly integrate into the local consumer's daily life and match their specific visual expectations for quality and trust. Selling food internationally is an exercise in cultural alignment. If the firm's output fails the cultural acceptance equation, the market will reject the product entirely. Selecting a market entry strategy requires balancing a spectrum of risk, control, and capital commitment. The entry mode ladder balances control and risk. Exporting offers low financial risk, but zero cultural control. Mid-level joint ventures share operational risk and profits with local partners. Foreign direct investment grants absolute supply chain control, but maximizes capital exposure and sovereign risk. Managers only authorize the major leap toward FDI when the foreign market's size and projected growth are substantial enough to satisfy this optimization equation, justifying the massive fixed costs and localized risks. To understand which global markets will justify those heavy investments over the next 30 years, we have to look past individual company strategies and analyze the macro-demographic shifts reshaping the entire industry. This chart displays a demographic paradox. The purple line shows the annual population growth rate, which has been steeply declining for decades. Yet, the green area reveals that total human volume continues to climb toward 10 billion, creating immense pressure on global supply chains. Crucially, this growth is highly concentrated. By 2050, the overwhelming demographic center of global consumers will be located across Asia and Africa. This population boom is occurring alongside severe income inequality and a rapidly urbanizing landscape. This creates heavily segmented markets, where demand for premium, high-quality products rises simultaneously with the demand for low-cost staples. Long-term strategic growth for agribusinesses relies heavily on capturing the rising purchasing power of these expanding middle classes in developing nations. As those incomes rise, diets undergo a structural transition. Consumers move away from basic, volume-heavy staple grains and begin demanding value-added proteins like meat, dairy, and heavily processed convenience foods. This side-by-side comparison shows the result. While bulk commodity exports, characterized by massive volumes but razor-thin margins, have flatlined, we see a steep, lucrative expansion in high-value products, or HVPs. However, capturing the high margins of HVPs carries a strict operational catch. Exporting fresh beef or specialized dairy requires unbroken cold chain logistics, strict sanitary compliance, and highly precise cultural branding. These complex requirements are nearly impossible to manage from thousands of miles away through simple exporting. To protect these fragile, high-value supply chains, agribusinesses are increasingly forced up the entry ladder, requiring joint ventures and direct foreign investments to maintain control. The strategy of simply loading raw grain onto a ship and hoping for the best is no longer sufficient. The future of international agribusiness belongs to firms that utilize rigorous optimization models to align their capabilities with local cultures, securing their position in the highest value markets in the world.